Welcome to this YouTube channel. The goal of this channel is to teach you specifically how to do problems and not to lecture. My hope is that you are connected to an able professor who's able to teach you or lecture you around the concepts. My goal is to teach you exactly how to do these concepts. What we're going to be focusing on in this video is how to write off debt. Okay, so a couple of things you need to know as foundational in this conversation is a couple of things. The first thing you need to know, number one, is what is bad debt. Okay. So you need to know bad debt. Bad debt is very critical. There are good debts and then there are bad debts. A good debt would be a debt that you leverage for, more capital. A good case in point is taking out like a small business loan. That's a good debt. Although you are indebted to a bank and you have to pay back that money, it's also a good debt because you leverage the money that you receive from that loan to make or generate more money. But then there is what is called bad debt. Bad debt is bad. What is bad debt? Bad debt is uncollectible amounts of money. Okay. So when you are doing business on credit, people are going to owe you money, right? And people are going to owe you money. But the truth is, there's just different kinds of people. There are people who are going to say, hey, I will for sure pay you back. I will do everything in my power to pay you back. And they actually pay you back. And then there are individuals where they say they're going to pay you back, but they never pay you back. So, what do you do in a situation where someone owes you money, but you believe you cannot collect that money? We call that bad debt. Well, here in America, what we can do with bad debt is we can write it off in our taxes or on our taxes. So that's a benefit to every business. So a business can claim as a loss every debt that they find uncollectible. So it's a good thing. So we want to, as accountants, talk about, well, how do we A, record and B, calculate bad debt? How do we A, record, B, calculate bad debt? So we record bad debt through what we call a write-off journal entry. So write-off journal entry is a journal entry that's specifically designed to write off bad debt. What do we mean by write off bad debt? To remove the debt from our books. Okay. So when we talk about write off, we're talking about removing the debt that someone owes us from our books. In other words, removing the amount from accounts receivable. That's really the goal. Remember, accounts receivable is money they owe us on credit, right? So when someone owes us money on credit, we have the expectation that they will pay back later. But when we finally come to the conclusion that they will not pay us back, we write it off, which is we remove it from the accounts receivable books. We remove it from that account because we no longer hold them to the expectation that they would pay us back. Now, there are two, very critical, there are two ways to write off debt. Two ways to write off debt. The first one, we call it the direct write-off method. Okay. The first method is called the direct write-off method, and the second is called allowance for doubtful, or the allowance method. Forgive me. I'm getting ahead of myself. The allowance method. So here we have it. We have two ways to write off this bad debt. First one is the direct write off, and the second is the allowance method. So, one more thing you need to know before we go on to do problems is that you can write off debt from two perspectives. So, two perspectives. I like to always throw this one in here to not cause confusion along the way. But there's two perspectives for writing off bad debt. You can write it off from the individual level, or you can write it off from the financial statement level. Okay. So these are the two. the two ways. And when we say individual level, we quite literally mean the account receivable level. And then for the financial statements, we look at the total sales level. So we're going to get into all of that by way of problems. But I think that it's super important that we kind of discuss this so that we can frame our conversation better. So let's look at the first problem. The first problem says Dexter Company uses the direct write-off method. Prepare journal entries to record the following transactions. All right, so it says on March 11th, Dexter determined that it cannot collect 45,000 of its accounts receivable from Lear Co. So this is going to be under the individual level. So this problem is related to how do you write off bad debt? How do you write off uncollectible amount of money under the individual level? Okay, using the direct write-off method. Well, first, it's going to be a journal entry because we talked about it in our notes. Write-offs are journal entry. So with every journal entry, we're going to start off with the date. So we go 11, March 11th. All right. So it says, we determined that 45,000 of its accounts receivable from Lyrico cannot be collected. So because this is under the direct write-off, right? You want to make this distinguish is very critical. The direct write-off, it uses bad debt expense, bad debt expense as the write-off account. So bad debt expense, you want to put it right here for you. Bad debt expense, it is an expense account. Okay. It is an expense account. So that means that the normal balance, so let me just write that down, is an expense account. So that means the normal balance is debit. And if you are not familiar with that language, normal balance, you definitely want to go back to my previous videos where I kind of break down T accounts, accounts, and journal entries. So look for that, look for that description or look for that title in the video, and you can definitely get that information. All right. So bad debt expense, I put bad debit, forgive me. Bad debt expense is an expense account and the normal balance is a debit. So in other words, what we're saying is this 45,000, we're counting it as a loss. Okay, we're saying, you know what? We're not going to think too much about it. It is what it is. It's a loss. We write it off. So we put it as an expense. Now, the reason why I'm teasing that out is because expense by definition refers to money that is going out for operational expenses. So money that is going out for operational expenses. So the direct write-off method says, hey, we're just going to claim this automatically as a loss. We're not going to think too much into it. It is what it is under direct write-off. We're not getting that money back. So we say it's an expense. So the increasing side for the expense account indeed is a debit. So what we're going to credit in this case then would be accounts receivable. Now you want to put accounts receivable Lear Co in there or accounts receivable, whatever the customer's name is, because every accounts receivable account is attached to a customer. And that's very important for bookkeeping records, right? For bookkeeping records, excuse me, it's very, very critical that we just make that mental note. Hey, this accounts receivable is attached to this customer. So we go accounts receivable for 45,000. All right. So then we go to March 29th. So on March 29th, it says Lyrico unexpectedly pays its account in full to Dexter Company. Dexter records its recovery of this bad debt. So now we have a situation where we thought on March 11th that we were not going to receive this money. Now, 18 days later, in fact, Lear says, you know what? I have the money here. Let me pay you. So there's a two-step process when it comes to getting back that money. The first step is we have to recognize the fact that we have already removed this from the books. When we credit accounts receivable, we are, excuse me, reducing the accounts receivable. So that means that we've removed it from Lear's code accounts receivable books that he owes us this money. So on the 29th, when he gives us back this money, we look at the his books to see whether or not he owes us this money, and we see zero. But the reason why we see zero is because we wiped it off from his account. So what we need to do, step number one, is put it back on his account that he owes us money. We need to put it back on his account that he owes us money. So how we do that is by reversing the journal entry that we did on March 11th. So instead of crediting accounts receivable, we're going to debit accounts receivable for that 45,000. Okay. For the credit, we're going to credit bad debt expense. We're going to credit that bad debt expense for 45,000. All right. So we credit bad debt expense for 45. So that's the first step. But then the second step is that we actually need to record the payment. So now that we put it back on his books that he owes us the money, now we can properly record the payment because at the end of the day, he unexpectedly paid us the full amount. So we are going to record the payment. How do we record the payment? Well, we're going to debit cash, obviously, because cash is coming in. If they paid us that money, that means cash is coming in. So we debit cash for 45,000 and then we credit accounts receivable for 45,000. All right. We credit accounts receivable for 45,000. Okay. So this is how we record bad debt expense, or this is how we write off bad debt expense for the direct method under the individual account. So what we're going to do now is we're going to look at how to write off bad debt on the individual level, both for direct write-off and the allowance method. Okay, so for problem number two, so let me just set this up real quick. For problem number two, what we're going to do is we're going to now look at a situation where we do direct write-off and the allowance method. Okay, we're going to look at both of those. So you get to see the difference. All right, so let's do it this way. I'm gonna come here and I'm gonna start off with direct write-off. Okay. So direct write-off. We're gonna look at that. We're gonna look at doing this again just to solidify what we just did a moment ago. And then we go from there. All right. So we're gonna look at this. We're gonna look at this one together. So it says prepare journal entries for Salco to record the following under the direct write-off method and the allowance method. All right. So it says May 3rd, Salco determines that it cannot collect its accounts receivable of 2,000 from Joey Co. So same energy, right? We're gonna go 5-3. We're doing this for the direct write-off method. So we already know what we're gonna debit because we talked about this a moment ago. We're gonna debit uh, bad debt expense and we're gonna do that for 2,000. Let me just go ahead and format the entire thing. Okay, so we're gonna do that for 2,000. And what we're also gonna do is we're gonna credit, remember what we talked about before, accounts receivable, Joey Co. for $2,000 as well. Okay, so that's gonna be that first journal entry, right? Pretty basic. We just kind of went over this. We just went over this. So cool. All right, so now we move, right? Now we continue. So now let's go to May 21st. So on May 21st, it looks like we had unexpectedly received that $2,000 from Joey that was previously written off. All right, so now what do we have to do? Remember, again, we're solidifying the very thing that we just did a moment ago. The first step, what we're going to do is we're going to reverse what we did on May 3rd because we need to put it back on our books that Joey owes us this money. So we're going to come and reverse what we did up here by debiting accounts receivable instead of credit and by crediting bad debt expense instead of debiting, right? So we're just quite literally reversing the original journal entry, just reversing it. And then the second step, now we record the payment. So remember, we started off saying that it was uncollectible. So we remove it from our accounts receivable by crediting accounts receivable. Then a couple of days later, he comes back and says, hey, I can pay you back that money. Okay, great. Well, we need to put it back on his accounts receivable account that he owes us that money. We can't just take the money and it shows that he does not owe us money. That's not integrity. So with recording integrity, we have to put it back on the books stating that he owes us that money. So we did this here. Then we follow up by recording the cash payment. So obviously, Joey gives us cash because you can only pay debt with cash. You can't pay debt with debt. I mean, you can try to do that, but that's not a wise way to leverage money. So you can only pay cash with debt. So we debit cash 2000 because that's what we're receiving. And then we credit accounts receivable because he's paying off that debt. He no longer owes us said money. All right, so there we go. This is under the direct write-off method. But now let's look at the allowance method. Now, the allowance method is honestly, my friends, the allowance method is not that different than the direct write-off method when you're looking at it from an individual approach. In fact, the only difference between the direct write-off and the allowance method is one account. All right, it's just one account. So you're going through the same steps, right? So the first step, number one, is we're going to write off the bad debt. Okay, so we write off the bad debt. Now, for direct write off, we use bad debt expense. But for the allowance method, we use allowance for doubtful accounts. Now, I have to take a moment to explain this new account to you all. Allowance for doubtful accounts is like a temporary account. Okay. It's an account that we kind of pocket on the side and say, hey, in the event that um, this person that we are saying that their funds are uncollectible, in the event that they may pay us back, we're just going to pocket it off to this side. And that's very useful to us. Why is that useful? Well, if direct write off says, hey, we know for certain that we're not going to get this money back, and we put it in the expense account, we're ultimately impacting our income statement. But the allowance for doubtful accounts, this is representative, or it is represented, excuse me, in our balance sheet. So that's pretty it's useful. Why is this useful? Well, it's useful for us as accountants because now we have wiggle room in how we want to position ourselves or present ourselves to investors. No different than if you're doing an interview, you want to put your best foot forward. And depending on what position you are applying for, that's going to determine what you accentuate or what you emphasize on your resume. So if you're applying to a retail job, you're going to focus on your retail experience, maybe not on your nonprofit experience, right? But if you're applying for a nonprofit, you're probably not going to focus on retail. You're going to focus on more office or clerical work, right? Well, the same is true in this situation that if we are looking at investors who solely care about our profit, then it may behoove us to write off our bad debt and show that in the balance sheet and not necessarily in the income statement, the profit, right? So that is just super high level. That's probably for those who want to dive deep into accounting. So I'm not going to overwhelm you with or inundate you with that information. I just want to kind of set the tone or create that demarcation in your mind, the difference between direct write off and allowance. And that is, again, that direct write off uses the expense account, whereas the allowance method, it uses this liability, this temporary account. So, anyways, it's still going to follow the same format. We're going to start off with writing off the debt. So, we're going to debit allowance for doubtful accounts, and we're still going to credit accounts receivable. Because again, we're removing it from his account. All right. Then it says on May on May 21st, it says, well, hey, Sal pays us back. Let me change the name here. Sal, he actually pays us back. Okay. So great. Thank you, Sal. So again, what do we need to do? We need to again put it back on Sal's books that he owes us said money. Okay. So how do we do that? Well, we're going to debit accounts receivable, Sal. Okay, remember when you debit accounts receivable is normal balance is a debit, so you increase accounts receivable with a debit, and then you're going to credit the allowance for doubtful accounts. So again, same exact thing we did with direct write-off. We're just reversing the prior transaction. All right, we're reversing the prior transaction so that we can then lastly record the payment, which is going to be a debit to cash for 2000 credit to accounts receivable, Sal, 2,000. Okay. So there you have it. There you have it. Now I want to draw your attention. Okay. If you were to look at the direct write-off method as opposed to the allowance method, what is the difference? Okay. If you were to look intently, there's only one small difference. And that small difference, my friends, is that again, for direct write-off, we're using bad debt expense. But for the allowance method, we're using allowance for doubtful accounts. The position does not change. The only thing that changes is the account name. So hopefully you pay careful attention to that. So that way you can ensure that you do well there. So let's go to the third problem. We're going to go to the third problem. In this problem, we're going to look at very, very interesting stuff. But we're going to look at, well, remember we said, hey, there are two perspectives for writing off bad debt. There are two perspectives. Perspective number one is the individual level. So that's the first two problems that we just did. But then you can also write off bad debt from a financial statement level. So that's what we want to look at. How do we write off bad debt from a financial statement level? Okay. How do we write off bad debt from a financial statement level? Now, there's two ways. Let's go back to our notes. Let's build out our notes. Okay. So there are actually three ways to write off bad debt from the financial statement level, but all three of these they follow one universal approach. That is, we're estimating bad debt. Okay, I probably spelled that wrong, but no worries. Okay, we're estimating bad debt. That's the heart behind the financial statement level. Writing off bad debt from a financial statement level, we're estimating. Okay, there are three ways to go about it. I will only share two. The third one is not that important to me. So the first one is called the percentage of sales. Okay, and the second one is called percentage of receivables. Okay, or you can say percentage of receivables or percentage of account receivables. Whichever one is fine by me. Okay, so these are the two ways we can write off bad debt or we estimate bad debt. So what's happening when we're looking at writing off bad debt from a financial statement level, what is happening is that we're looking at the financial statements. More specifically, we're looking at our sales, our credit sales, and we're asking ourselves the question of the credit sales that we have, how much of that is uncollectible? Okay. Of the credit sales we have, how much of that is uncollectible? In other words, we're trying to be realistic with ourselves. Like you're a student, midterms come around, you get your midterm grade, and you ask yourself the fundamental question based off of how I've been performing, based off of the content in this course, what is the realistic grade that I can receive from this class? Business people do this all the time, right? It's being realistic, right? It's hedging your bet, as it were, right? Like, so you're looking at your financial statements. We made 500,000 this year. Great. Awesome. Congratulations to you. However, that does not necessarily mean that we would collect all 500,000. How much of the 500,000 will we collect? How much will be considered uncollectible? So we're just having a realistic conversation about our financial statements. So, truth be told, is that you can never really know with accuracy how much money you're going to collect or receive from a customer based on a credit sale. Like you don't know. You can't play God in that situation, right? Like some people may pay us back, some people may not pay us back. The people that we think will pay us back may not pay us back. The people that we think will not pay us back, they probably end up paying us back. It's all hypothetical. But we need to come up with a strategy with estimating bad debt so that we will not be caught by surprise when this occurs. So the two primary ways that we estimate bad debt on a financial statement level, number one is called the percentage of sales. Number two, percentage of receivable or accounts receivable. So what I want to do is kind of go over this problem looking at, well, how do we then estimate bad debt looking at these financial statement level on this financial statement level? Give me 1 second. Let me just uh do something here. Make sure I am good for time and I'm moving according to my notes. Okay, what are we looking at? What are we looking at? All right, awesome. Awesome, awesome, awesome. Okay, so it says at year end. So we're looking at this problem. It says at this year end, December 31st, Chan Company estimates its bad debts as 1% of the annual credit sale of $487,500. Chan records its bad debts expense for that estimate. All right, so let's stop there. Okay, so on December 31st, so again, these are all journal entries. So good news is we still follow that same format with date, account name, debit, and credit. All right, so the date is going to be 12/31 because it quite literally says at December 31st. It says we estimate that 1% of our bad debt or 1% of our annual credit sales will be considered bad debt, right? So, how do we make that journal entry? Okay. So, here's the journal entry. And the good news is the accounts does not change. Whenever you're dealing with financial statement, whenever you're writing off bad debt from the financial statement level, the accounts does not change. They are what they are. We're going to debit bad debts expense. We're going to debit that for 1% of $487,500. So obviously 1% of that is going to be $4,875. So we debit for that amount. Okay, we debit for that amount. And then we're going to credit allowance. Allowance for doubtful accounts. So that's what we're going to credit there. And that's it. Okay, so that's it. So pretty straightforward, very clean to the point. Debit bad debt expense, credit allowance for doubtful accounts. But it that does not complete the problem. It says on the following February 1st, Chan decides that $580 account of P Park is uncollectible and writes it off as bad debt. Now let's stop there. So this is different though. Okay, so now on February 1st, they're now bringing it on an individual level. So you see on December 31st, it was on a financial statement level because it's talking about credit sales. Where do we find sales transactions? We find that on the income statement. So December 31st was financial statements. However, February 1st is referring to the individual level. So they want us to now do journal entries on an individual level. So let's look at doing journal entries on the individual level. We can do this both, remember, we can do this both for direct write off. So let me put that in there direct write off and the allowance method. So we can do it for both. So why not do it for both? Again, we've done this, so we just kind of keep the same energy here, right? So if we are saying 580 is uncollectible under direct write-off, what do we do? We're going to go ahead and debit bad debt expense for that 580. And what are we going to credit? Accounts receivable, P Park, right? So that's going to be credit. You should be a pro at this. I know you're a pro. Why? Because you're awesome, right? So I know you know this. All right, so we remove it from there. We remove it from P Park's accounts receivable account. But then it says, hey, on June 5th, so let's go ahead and put that on there. So 06. So on June 5th, it looks like they unexpectedly paid us. So a couple months later, they paid us back. So what do we need to do? Pregnant pause. Yes, you got it 100% right. We need to put it back on there. We need to put it back on P Park's account receivable account that they owe us the money. In other words, we need to reverse what we did in February. So we debit accounts receivable for 580 and then we credit debit or excuse me, we credit bad debts expense for 580. And then number three, we just record the cash payment that we received. So we debit cash, 580, and we credit accounts receivable P Park, 580. All right, good stuff here. So that's under direct write-off for the individual account. Let's do it for the allowance method. Okay, let's look at writing it off for the allowance method. For the allowance method. All right. So we're gonna go date, journal entry, debit, and credit. So we're still gonna use the same journal entry format. So February 1st, same thing. We're gonna write off the debt. Instead of using bad debt expense, we're gonna use allowance for doubtful accounts, right? So we've done this before. We're still gonna credit the accounts receivable P Park, right? So remember, we said that there's no big difference between allowance and direct write-off. It keeps the same steps. The only thing that changed is that account. So for June 5th, they gave us the money back. We need to reverse what we did. So we debit accounts receivable for 580 and we credit allowance for doubtful accounts. We credit that for 580. Okay. And then we just record the cash payment. Good news is it stays exactly the same. Stays exactly the same. Nothing changes. So we keep it there. All right. So that is again problem number three. So we looked at how to write off debt, not only from the financial statement, but also the individual level too. Okay. So we looked at this is a problem where we did it for both. We're going to do one more problem and be done for today. And that problem is problem four. And we're going to look at it solely on the financial statement level. Okay. So I want to spend some time looking at how do we write off bad debt from the financial statement level. Remember, we said that there's two methods. Method number one is percentage of sales. So let's do that one first, and then we'll do percentage of receivable. All right. So percentage of sales, I mean, it's what the name suggests. We're taking percentage of the sales, the credit sales that we receive. So it's pretty straightforward for the most part. It follows a formula, but the formula is pretty basic. It's just you're multiplying some things. So don't freak out about, having to use formulas. It's just a basic run-of-the-mill formula. So let's get into it. Let's dig into it. So it says Maisie Supply Co. uses percentage of accounts receivable method on December 31st. It has an outstanding balance or outstanding accounts receivable of 55,000. Okay, so this is actually for not percentage of sales, but accounts receivable. So no worries. So we do percentage of accounts receivable. So remember what I said earlier that the accounts for the financial statements, they don't change. So that is super good. So we can actually come here and just copy and paste that stuff. No worries. It's always going to be a debit to bad debts expense, and it's always going to be a credit to allowance for doubtful accounts. Those are not going to change, right? Those stay the same. Now, where we have to do some work is the amount. So it says that the outstanding balance in accounts receivable is 55,000 and it estimates that 2% of that is going to be uncollectible. Now, so here's how this works. We start off by taking, um, I'm going to do a formula here, but I'll break it out in a little bit. So we start off by doing the formula. So the formula is going to be 55,000 multiplied by that 2%, right? That one is pretty clear. Because if we're trying to figure out the bad debt, all we need to do is just take 2% of the 55,000. So the 2% of the 55,000, the 2% of the 55,000 is going to give you 1,100. All right. However, we must also not only record the bad debt expense as it relates to the percentage, But we also have to either add or subtract any previous balance that was in the allowance for doubtful accounts. Okay, so that's very clear. So the formula is as follows. We're going to take the total accounts receivable balance, we're going to multiply it by whatever the bad debt percentage is, and we're either going to add in a debit balance or subtract a credit balance. Okay. So if we're looking at A, it says we have a $415 credit balance that was left, that still remains rather in allowance for doubtful accounts. Okay. Cool. So remember, you want to put this in your notes. If there is a credit balance in allowance for doubtful accounts, then we subtract, okay, from the uncollectible amount. If there is a debit balance left in the allowance for doubtful accounts, then we add it to whatever that uncollectible amount is. So for A, it says that we have $415 credit balance left. So we're going to do the 550 or 55,000 multiplied by 2% minus that credit balance of 415. All right, what did I do wrong here? Give me 1 second. Let me see. So let's just do this. Oh, okay. It doesn't like the comma that I put in there. So I put a comma in there. Okay, so we're gonna do 55,000 multiplied by the 2%. Where did you get that from, Dr. Akin? Problem says our accounts receivable balance is 55. We want to take 2%, or 2% would be considered bad debt. And remember, the formula says if it's a credit balance that's left in the allowance for doubtful accounts, we subtract. So we subtract that 515 from it. That means then we're going to debit bad debt expense for 685. So let me just put it here so that it's clear. So formula for percentage of accounts receivable. So remember, the formula is total accounts receivable balance multiplied, let me just put an X in there, multiplied by the bad debt percentage, right? So that the quotient of that, okay? So whatever the total is, so I'm just going to put total. We're either going to, you want to write this down, subtract credit balance in ADA, or add debit balance in ADA. Okay. So that's the formula that you want to remember. So in this case, again, we took the 55,000 multiplied by the 2% minus 415. So with that in mind, what do you think this scenario is going to be if there's a debit balance of 291? Well, the accounts are going to stay the same. So we're still going to do 55,000, and we're going to multiply that by 2%. And rather than subtracting the 415, we're going to add in the 291. Because why are we adding in the 291? Because the formula says if there's a debit balance, we add it to the total. So that's exactly what we're doing. So that means then we're going to debit bad debt expense, for 1391, and credit allowance for doubtful accounts for 1391. Okay, my friends, I think that's a lot. Remember, if I went too fast, make sure you stop, pause this video, take time. You can slow it down. For those who feel like they know what they're doing but just need additional practice, you can two-speed this. So, hey, I hope this was helpful. Enjoy your studying.